Bitcoin is the safest, the most secure of the blockchain technologies. And I think that is a huge consideration for institutions. Security, safety, is this thing going to blow up on me? So Bitcoin is the most secure, makes sense. It's the right place to start. The correlation of returns very low. And it also is the leader of the pack. If you look at 2017, as the crypto world took off, led by Bitcoin, here again in the last 6 months, led by Bitcoin. Ether was very slow this time to respond, but came on obviously once confidence increased, came on very strongly. Different. I think institutions will diversify into other crypto assets, but they have to walk before they run, and I think they have to feel safe and secure in the knowledge that their assets are not, as I said, going to be in harm's way. Maybe the volatility is there, but that their Bitcoin will be there. It will not be confiscated in any way that they might fear. So I think that's why you're seeing the step first into Bitcoin, and then as a launching pad into others. And, it's also interesting. I think after 2017, we watched carefully the network dominance, and different people measure this differently. But just for the sake of argument, at the peak in 2017, Bitcoin accounted for roughly a third, maybe 30%, 33% of the network value of the crypto world. At its peak during the depths, during the coronavirus crisis, and and a little bit after that, it had gone up to, again, depending on the measure, high 70s, low 80s. That tells me, or reminds me, and Yassine and our team, that Bitcoin is the reserve currency of the crypto asset ecosystem. It is the flight to safety currency. And I do believe that's still the case.
But can I just say something? Because I think you guys will enjoy this, okay? And what Cathie said, not only do I agree with, but for people in the crypto space, it felt like Bitcoin was too boring for them about a month or two ago. And I'm like, oh my God. I mean, compared to the institutions I deal with, Bitcoin is the hot tamale. But there are coiners out there. They think, oh, Bitcoin, that's the reserve currency of crypto. You see what I'm saying? My point is we have so far to go in terms of the adoption. It is so early, guys. Yes. That's my message.
Yeah, and I'd liken it, and Yassine wrote a white paper on it. It's on our site. And we took a look at how the ecosystem is likely to evolve. And I think we used, I think it was 1 million Monte Carlo simulations, just trying to figure out, okay, if institutions start moving in, where will they go? Well, they'll tiptoe in. A Mass Mutual, I guess, was $100 million for their general account, which is it's probably 0.002% of their general account. So that's really tiptoeing in, and just gives you a sense of how far we have to go. According to those simulations, in order to maximize the Sharpe ratio, an institution might move towards, in crypto assets, we did it on Bitcoin, 6% of a portfolio in Bitcoin, in order to minimize volatility and enjoy the increased return associated with crypto. That percent might be more like 2.5%. And it reminds me of the emerging markets in the 1980s. MSCI came along and said, hey, wait a minute, these countries, they're all emerging markets very early on, but they each have idiosyncratic risks. Why don't we put them all together in a portfolio? And returns will be higher, risk lower than in any one alone. I think the same thing's going to happen to the crypto asset ecosystem, starting with Bitcoin and Ether.
How do you guys think about the macroeconomic environment? Michael Saylor, Anthony, he said something like the world changed in last March. And like, how do you think about, real yields? Some people call it the everything bubble, where returns on sovereign debt are negative. And I feel like this is kind of a driving force for Bitcoin adoption, central bank liquidity, just kind of driving up all assets. What are your thoughts on Bitcoin as a risk on versus risk off asset, how that might evolve, and really just the macroeconomic environment in general?
So to be clear, it's probably perceived right now as a risk on asset. But I think longer term, and if you look at it, I think the way Cathie and I are looking at it, that we're embracing the volatility. Remember, volatility may not be a measurement of risk if you understand fundamentally what you own. So you can use the volatility and the manic depression of the markets to take advantage of the markets. And so when you look back at the macroeconomic backdrop and you study cycles of history, we know one axiomatic fact about fiat currency: politicians, policymakers, kings and queens print more of it because it's an easy short-term solution. The Roman emperor with the bread and circuses, it's a distraction and it's a solution that will calm down the problems of a society in the short term. And I think the brilliance of Satoshi Nakamoto, and it goes right back to John Maynard Keynes, because remember, coming out of the war, Keynes wanted at the Bretton Woods conference a uniform currency. He asked for it. It didn't become politically expedient to have it. And of course, the dollar supremacists at the table didn't want that. They were just feeling their oats as the dollar was taking its force as the global reserve currency. But Cathie pointed out, if you're going from $4.5 trillion of dollar volume to $7.5 trillion of dollar volume, my friend Ross Stevens at NYDIG puts it better than everybody. You just got taxed, ladies and gentlemen. The government didn't impose it on you, but they secretly did it through the central bank, because go look at your bank account now. If you've got $10,000 in your bank account and they just printed 30+% more dollars, well, the purchasing power of your $10,000 has eroded. And remember, your time and your money are conjoined. And so what's happening is they're taking your time from you by doing that to you. It's a form of erosion. And so to me, what Nakamoto said, the brilliance, remember, the best ideas come in the simplest form. What he's basically saying to you is, if you can create this decentralized situation and the money actually becomes stable and cannot be affected by policymakers or politicians, it will have a remarkably positive effect on the world. Now, I'm going to show you guys something that I stole from Jack Dorsey. Okay, you want to see it? This is my Bitcoin clock, right? I had Bitcoin envy, block clock envy, when I saw him testifying and saw this behind, so I bought it, right? And so what does it say on here? And Cathie, you two guys are too young to be impressed by this, but Cathie knows how old I am. I'm going to read this without my bifocals, okay? Just to show you how, okay? What does it say on this clock? If you don't believe it or don't get it, I don't have the time to try to convince you. Sorry, Satoshi Nakamoto. And so when you step back and look at the macroeconomic backdrop, if you understand that white paper, you have to be in Bitcoin. It is a part of your risk management for the future, as opposed to a risk on asset. I'm sorry to be so long-winded, but I was on a roll. I was on a roll there, Cathie, and I was trying to use all that dramatic flair. That's
I love it.
Case background there. You see the fire going and stuff.
You're featuring the inflation tax risk, and I completely agree with that. It's an insurance policy. But there's another side to this. So Ray Dalio earlier this week said he'd prefer to own Bitcoin than bonds. Now, he's worried about a deflationary bust. And I think the truth actually is somewhere in between. He is worried about the counterparty risk that is going to occur because of a deflationary bust in the global ecosystem. So think about it. We're talking about a hedge against inflation and a hedge against deflation. That's pretty good. That is pretty darn good. I don't think I know of another asset, maybe gold, but no, I actually think this is the first rules-based monetary policy, global, stateless, and trustless. So I think we're on to a completely different animal here, and it's pretty exciting.